If I had to buy just one mutual fund for the rest of my life, this video tells you exactly which one. In fact, I'm going to share 7 mutual fund ideas for a one fund portfolio that busy people can use to get maximum returns with zero complexity and better safety. And here's the best part. People with these simple one fund portfolios often outperform those jungling 10 plus funds while taking on lower risk at times. A 10,000 per month SIP, just to give you an idea, with a 10% annual step up in one of these funds would have grown to over 7 crores over 25 years compared to 4.5 crores in a Nifty 50 index fund. So if you have zero time for research and market analysis, you can still build generational wealth. A one fund portfolio gives you back your most valuable asset, your time. No more endless comparisons, no decision analysis paralysis, not constantly second guessing yourself. Hello everyone, I am Udayan Adhye and I have been licensed in Indian financial services since 2015, and so far I have helped over 2,000 families make smarter financial decisions, and here on my YouTube channel I talk about all things money and personal development. So let's start off with idea number 1, the Nifty Large Midcap 250 Index Fund. This particular fund, along with one more that I mentioned later on, is actually one of my personal favorites from this entire list. Here's how this works. 50% of your money goes into India's top 100 large cap stocks. These are India's 100 largest stocks, and the remaining 50% goes into 150 mid cap stocks. And the index rebalances every quarter to maintain this perfect 50-50% split. I love it because you get the stability of large caps combined with the growth potential of mid cap stocks. Let me put the returns in perspective. A 10,000 per month SIP with a 10% annual step up over 25 years in this particular index would have grown to 7.64 crores. That's a total gain of 6.46 crores. And this is over 3 crores more than if you're invested in a simple Nifty 50 index fund. This index has a standard deviation of 6.15 versus 4.18 for the Nifty 50 index. And in fact, let me show you how it has fared against the Nifty 50 in a more graphical way. So here we go. Look at the large midcap 250 index, and you will see that almost at every point in time except for just before the COVID crash, you would have seen that this index actually gave lower returns than the Nifty 50, and for a very marginal window in the mid 2010, so in about 2014. What is very interesting to note here is look at the median rolling returns, right? 17.3%. And that is why you have that excess 3 crore return that has been generated over 25 years. Whereas the Nifty 50 is at 13.2%. The standard deviation, yes, is higher than Nifty 50, but for over 4% annual returns over that long window, I think that's wonderful. That's understandable because you're adding mid caps to the portfolio as well. One more very interesting point is look at how many times it has given over 20% annual returns on a 5-year rolling basis. Over 20% of the times, whereas Nifty 50 has barely done that, right? So once again, you'd notice that across different time frames in 2012, when you see the lowest point, just after the COVID crash, when you see the lowest point, this portfolio has never given negative returns so far. And that is the beauty of it, right? You get the stability of large caps, as I mentioned, with the injection of growth that mid caps lend. And as of today, at least 5 AMCs run Nifty Large Midcap 250 index funds. These are Edelweiss, ICICI Prudential, HDFC, Zerodha and Mirae Asset. Now, the expense ratios for direct plans in these schemes range from about 0.2% to 0.3%, so they are very tightly wound. If you want to apply what I share here on YouTube to your own life and investing, check out my program, The Complete Guide to Mutual Fund Investing. It has all my years of experience of being licensed in Indian financial services since 2015. In it, I have covered topics like how you can select mutual funds to invest in, how to build your mutual fund portfolio, a much deeper dive than this particular video, what is an SWP and how to plan for your various goals, among other topics as well. The guide also has Excel tools like this one, where you just enter the goal that you have, the money that you require for it, and it automatically tells you, factoring in inflation, how much you need to invest per month from now onwards and which mutual funds to go for to save for that goal. Once you sign up for the guide, you'll also be part of our monthly live Q&A sessions where I answer all your doubts. To check out the program, go to the first link in the description and the pinned comment. The second idea for a one fund portfolio is a multi-asset fund. These funds invest in at least 3 asset classes with a minimum of 10% in each. And these are typically stocks for growth, bonds or debt for stability, and gold for, again, capital appreciation and inflation protection. Some multi-asset funds also have real estate or REITs in them. Now think of these as a balanced meal, right, for your portfolio. The genius here is the automatic rebalancing. When stocks are more expensive, more money flows into bonds and gold. When the markets are going through a correction or there's a crash and stocks are cheap, the fund manager loads up on equity. You get professional asset allocation without lifting a finger. And the beauty is that while the fund managers move money from one asset class to the other, sell one, buy into another, you do not pay any tax because this is all happening at the fund level. Only when you sell your investment are you liable to pay tax. Now in this space, the ICICI Prudential Multi-Asset Fund is amongst the oldest in the category and among my personal favorites in it as well. It's also a part of certain client portfolios that we build, and a 10,000 per month SIP in this particular fund with a 10% annual step up for 25 years would have meant that you would have invested about 1.18 crores. But that would have finished with 6.69 crores. That's a 5.5 crore gain. And if you compare that to the Nifty 50, it has beaten it by 2.18 crores. Let's quickly have a look at how the ICICI Prudential Multi-Asset has performed. So I'm comparing the ICICI Prudential Multi-Asset Fund against the Nifty 50, and you'd notice here, right, that from about halfway through 2018 till about the end of 2022 was one pretty long period, almost a 4-year window when this fund did not do as well as the Nifty 50 on a 5-year rolling basis. But apart from that, right, over this entire long window, and if you notice the first date of record, right, is 2002. So that is across a 23-year window for just 4 years. This fund did not do well, otherwise it has always beaten the Nifty 50. Look at the median rolling returns once again. You would notice 13.3% for the Nifty 50, 16.9% for the multi-asset fund, and the standard deviation is so close, right? 6.7 and 7.6, barely a difference. What I love about this again is just look at how many times it has given over 20% annual returns on a 5-year rolling basis, right? Over 1/4 of the time, whereas Nifty 50 has barely scratched the surface. If you notice a difference, right, between why it's 7.5 and why it was 2 point something in the previous comparison, that is because the start dates are different. The ICICI Prudential Multi-Asset Fund is a much older fund, whereas the index that we are comparing, the data starts from about 2005. That's why this difference. The third idea for a one fund portfolio is a balanced advantage fund or a dynamic asset allocation fund. Now, in these funds, they do not have to maintain a fixed amount of equity or a minimum amount of equity. The fund manager can dial up equity or down depending on their philosophy and their approach. Although a lot of fund managers keep equity at 65% plus to retain the equity taxation advantage, right? Because if the equity levels in the fund drop below 65%, then you just have to wait a little longer for long-term capital gains to kick in. So when markets are expensive, fund managers tend to reduce equity in such funds. When there is a correction or there's a crash, they load up on stocks. It's like, again, having a full-time fund manager who never sleeps. And once again, the buying and selling that is happening in the fund is not a taxable event for you, right? You only pay tax when you sell your investments. So it's like you get a completely free rebalancing every single month, because as the fund manager believes with all their entire team's data and analysis, they make changes in the portfolio. Now, most balanced funds in India, when they invest in stocks, are largely investing in large cap stocks. So keep that in mind when you're investing in them. Not all, but most of them. The HDFC Balanced Advantage Fund along with the ICICI Balanced Advantage Fund are amongst the oldest in the history. In fact, the HDFC fund started in the 1990s, and despite being such an old fund, it is a star performer. On a 5-year median rolling return basis, a 10,000 per month SIP with a 10% annual step up for 25 years would have grown to 5.37 crores versus 4.19 crores for the Nifty 50. So it's almost 1 crore higher. I'll just give you an idea as to what the standard deviation of the performance has been like in a chart. So you'll notice once again for large periods of time, except for a very small window, once again right before COVID, right after COVID, this fund underperformed the Nifty 50, but otherwise has always outperformed it. Look at the standard deviation, 9.81 and 12.54. There is a difference there, yes, but again, you're getting very high returns. If I actually look at the total returns, right, that this fund has generated, and the DSP portal that I'm using to show you these numbers tracks this data from September 2000, even though the fund started in the 1990s. You'd notice that 1,000 rupees invested, right, just look at this, would have grown to over 50,000 rupees. That's a 50x return. Just imagine, right? Whatever you had invested would have grown by over 50 times. That is the power of just having a good asset allocation, having a good fund manager. Prashant Jain was the fund manager of this particular scheme for the longest time. He's now exited it, but even after that, the performance of this fund has not lagged. Now, the fourth idea is a Flexi Cap mutual fund. These give fund managers total freedom to invest across large cap, mid cap and small cap stocks with no fixed rules. If large caps are doing well, the fund managers tend to focus there, and so on and so forth for mid and small caps as well. Having said that, in India right now, most flexi caps are very large cap heavy. There are very few flexi caps that truly take advantage of this and let's say have 40% in small caps, 30% in mid caps and the rest in large caps. That rarely happens. There are a few funds that do that to some extent, but most are pseudo large cap funds. And the easiest way to tell whether your flexi cap is investing across different categories is to go to ET Money's page for that particular fund and just scroll down a little and you will see the asset allocation. Now I'm looking at the JM Flexi Cap here. Look at this. It has large cap as 45, 30% almost is mid caps, 23% is small cap. So there's a good mix, right, of different categories. If I go to one of India's most popular funds, the Parag Parikh Flexi Cap, if I scroll down, you'll see something different, right? Most of the money is going into large cap funds or large cap stocks rather, right? So just think about this. Of the total equity allocation, which is 75% in the fund, 71% is going into large caps. So it's safe to say that all the money, right, almost all the money is going into large caps. That is not the case with JM Flexi Cap. So the reason this becomes important to know is depending on just where the fund is investing, it will kind of move accordingly as well, right? So portfolios with higher mid and small caps tend to move a little more than portfolios that are large cap focused. Now in Flexi Cap as an average category, a 10,000 per month SIP with the other metrics remaining the same, that would have grown to 5.88 crores. Now that is over 1.3 crores more than a pure Nifty 50 index fund. And let's just look at how again it has performed in a graphical way, right? So you'll notice first up the standard deviation is very similar. I would say 1.5 point difference is not much. If I look at Flexi Cap as a category, you'll once again see for large parts of time, for majority of the times it has done better than Nifty 50. The rolling returns are 16.7% on a 5-year rolling basis for an SIP, 14.4% for Nifty 50. Here you will notice something interesting happening, right? You'll notice that the returns over 12% are 12 to 20% are very similar, but returns over 20%, 10% of the time, that is a third of the time rather, equity flexi caps have given over 20% annual returns, which is wonderful. Having said that, it's very important to note that flexi cap as a category, right, in its current form, only came into existence in November 2020. So the data that you see right behind this, all of that is backtested, it's extrapolated based on multiple factors. If I were to change it, right, let's just change it. So let's change it to November of 2020 and just see how it would have done. So let's just say 30th November to 19th. So there we go. We'll do a 3-year lump sum investment, which gives you a better idea, right? So there you go. So look at this. Flexi caps, once again, for a short window at the start and for a short window in the middle, they performed worse off than the Nifty 50. But at, again, majority of the time is the Flexi Cap index or the Flexi Cap as a category, has done much better. If I look at the actual distribution of returns, you will see that the median rolling returns are 15.7 for Nifty 50 and 17.4% for Flexi Caps, with standard deviation that is very, very similar. And this gives you a more accurate picture of how Flexi Cap has done as a category because this is now actual data, right? This is not backtested. Now, the fifth category is a multi-cap mutual fund. Unlike Flexi Cap funds, multi-caps must invest in all three categories, minimum 25% each in large caps, mid caps and small caps. This forced diversification ensures you always have exposure to different market segments. And here, right, a 10,000 per month SIP with the rest of the parameters remaining the same would have grown to 7.54 crores. That's a 6.3x gain. And again, the outperformance versus the Nifty is over 3 crores. Let's quickly have a look at multi-cap as a category. Very interesting to note that once again, multi-cap as a category only came into existence in 2018 when SEBI recategorized mutual funds. So we look at data from 2018 as well, but here's the backtested data. You'll right away see the median rolling returns are 18.5% stellar, whereas for Nifty 50, they are about 14.4. what I love about this, right, is look at the returns over 20%, annualized returns over a 5-year basis. It's 40% of the time, almost half of the time, multi-caps have given stellar returns. If we just change this to now, let's say halfway through October, we'll quickly realize something about how this portfolio actually has done, right? So here's 7-year market data almost, right? Let's look at this. Let's look at multi-caps, and you will see right away, right, that just before COVID, the performance was slightly lower than Nifty 50, but after COVID, it has been much better. Let's look at a slightly shorter rolling return window, because it's a 7-year window, so let's try to get more data points, right? So there you go. Once again, very similar to what the 5-year data was looking like. If we have to go into the specifics, there you go. This is the actual data, right? This is not backtested. 43-44% of the time it has delivered over 20% annual returns, which is fantastic. Under 0%, very similar, but the standard deviation goes up. And there's a reason, right? There's a reason, because we're adding 25% at least of mid and small caps each. Popular options in this space include multi-caps from HDFC, SBI and Kotak, amongst a lot of other funds. Now, the 6th category is the classic Nifty 50 index fund. It tracks India's top 50 companies, the giants that represent about 55% of the entire Indian stock market. So when you invest in the Nifty 50 index, you own pieces of companies like Reliance, TCS, HDFC Bank and Infosys. These are companies that are basically the Indian economy. A 10,000 per month SIP in this index over 25 years, with all the other parameters remaining the same, would have grown to 4.51 crores. Not bad, right? Just own India's biggest companies and you enjoy 3.8x growth on the money that you're investing. But now when you're selecting index funds, you want to ideally look at funds that have the lowest expense ratio and the lowest tracking difference. And if you look at these two parameters, then the index funds in the Nifty 50 space offered by Navi and Edelweiss make the cut. And the final and the 7th category is the Nifty 500 index. It tracks 500 of India's biggest stocks in one go, and that captures 92% of the Indian stock market. In this particular index, a 10,000 per month SIP with all the other parameters remaining the same would have grown to 5.58 crores. You see the difference, right? Just adding mid and small caps takes your returns from about 4.5 crores to about 5.5 crores. Now let's have a look at the charts and the exact numbers, right? So right away you notice the Nifty 50 index. It is closely hugging the Nifty 500 index, and there have been times when the other one has done better or the Nifty 50 has done better. From an absolute perspective, you have 15.8% as 5-year rolling returns for an SIP for Nifty 500, 14.4 for Nifty 50. The standard deviation, again, very close. I wouldn't read too much into it. It's that close. Again, very similar returns, right, across different parameters. So just goes on to show that adding a little bit of mid and small caps, what it does to your portfolio, right? Slightly increased volatility, slightly increased risk, but also potentially higher returns. Some of the index funds that track this are offered by Motilal Oswal, ICICI Prudential and SBI, with Motilal Oswal having the lowest expense ratio of 0.17. So which one should you choose? A Nifty 50 index fund is the most straightforward, right? Then a balanced fund or a multi-asset fund, they are great for people who want exposure to different assets, or even for people who get anxious while investing. We tend to have hybrid fund heavy portfolios, multi-asset fund heavy portfolios for people who are new investors when I'm building portfolios for clients. Then flexi cap mutual funds are a touch more advanced than Nifty 50 index funds. But remember, these flexi cap funds are actively managed, which means you always have the fund manager risk. Whereas with a Nifty 50 index, you are basically just buying into the index. The same is the case with multi-caps, where there's again fund manager risk, but that also gives you potential to get higher returns if the fund manager is skilled, and you get exposure to mid and small caps. So if you're okay with the higher volatility at the potential cost, so the potential gain of higher returns, then they are right for you. And if you want a balance of both steadiness and potential aggressive growth, then there is a Nifty large midcap 250 index fund. It's actually my personal favorite in this entire list, as I told you earlier, along with multi-asset funds. Now keep in mind two very important points while choosing a one fund portfolio. Firstly, remember these are all equity heavy strategies. So for lump sum investments, have at least a 7-year investment horizon. For SIPs, 7 years, great, but at least have a minimum of 5 years as your investment horizon. Secondly, when you're choosing this one fund, avoid thematic, sectoral or pure small cap or mid cap funds. We want a balanced exposure when we're just investing in one fund, not concentrated bets. Because if they do well, yes, they will do well. But if not, then remember all your money is in them. And that's not going to make you feel better, right? If the fund does not do well. So remember, investing, it does not have to be complicated. And if you want me to specifically analyze a particular mutual fund scheme that I've mentioned here or other funds that you have in mind, just drop their names in the comments and I'll review it in my flash series. And if you enjoyed watching this one, then check this video out where I share with you how I would invest 10 lakh rupees right now. I'm sharing 3 strategies in it: starter, moderate, and aggressive. I'll see you in the next one.